The last time I was in Argentina was half my life ago. I was 17 years old, so it's good to be back. The only memories I have from the first time I was here was dulce de leche and eating really, really, really good meat. So it's good to be back in Argentina. I've spent quite a bit of time in countries across the world, more recently a bit of time in Switzerland, and people are really, really stiff here. So it's nice to be in an ecosystem with a great culture and a lot of energy. I was privileged to meet 36 startups on Monday when we were doing the mentorship sessions, and I was pleasantly surprised at the maturity of the use cases and the talent that is present in Argentina. And at Lisk, Latin America and specifically Argentina is a big focus for us. So before I get into the presentation, I'm going to talk a little bit about Lisk and who we are. And then from a VC perspective, I'll tell you a little bit about what we look for when we raise capital. And from my experience, from being an investor and being on that side of the curtain, what specific points I think resonate with VCs and investors when engaging with startups. But before I get to that, maybe I can just get a sense of the room. Who is raising capital in this room? Okay, we've got a couple here, unless we have a lot of rich founders. And who's heard of Lisk? So a lot of you, I imagine, would have entered the crypto space in the past cycle or two. Lisk has been in the space since 2016, and I'll give you a quick rundown of who we are. And then the last question, who thinks Bitcoin will be at 100K, back at 100K at the end of this year? Nice, okay. A little bit of a bare audience, but good to see some hands up. Okay, guys, so I can give you a quick rundown of Lisk so you have context as to who we are as an ecosystem and as a business. So we launched back in 2016, one of the OG layer 1 chains. It was a JavaScript chain back then. I'll tell you a little bit now how we've pivoted and evolved since then. That was during the ICO craze, so venture capital didn't really exist at that time, at least not in the Web3 environment. So we raised 14,000 Bitcoin from the community. Of course, there was a lot of infrastructure businesses or protocols that launched back then. We always had the view of focusing on utility, and we're in the space for the long run. So we've managed our treasury very well since our launch, and a lot of that is now going to be dedicated into investing into projects, which I'll get into a little bit more. As time went on, the ecosystem became more complex, more competitive, and we decided to align ourselves with an ecosystem that's more developer friendly. So we pivoted to an L2 in the Optimism superchain, so we're an EVM chain now. And then we also decided, because of our view on the market, and in summary, really it is that we're in it for the long run. We don't chase narratives that don't have any value. We focus on utility. I mean, if you look at what's happened over the past couple of years, I think a lot of people originally got into the space because they could see what this technology could do, how it could disrupt entire industries. And a lot of people looked at this technology, as I did when I entered the space, is it was sort of like sticking it to the man. And then over time, it's really evolved and changed quite a lot, and not all of that is for the better. I had a sense when I went to Token 2049 this year in Singapore, and it felt like I was at a casino conference. And I think there's a big part of this industry that's got a gambling culture to it. We've lost a bit of the utility. My belief is that institutional adoption, although it has a long, long way to go, it really is at an all-time high right now. Institutions are ready to adopt this technology, and they're looking more seriously at what blockchain can do. On the retail side, there was actually a really interesting, some data that was circulating around a couple weeks ago, on-chain data, that showed that only 1% of retail investors are making a profit right now. So retail sentiment is really at an all-time low. 2017, there was 3,000 tokens in the market. Everyone was a fund manager back then. And now there's 35 million. So the liquidity has been sucked into meme coins and projects without utility. Our focus is really on utility. We're not chasing hype, and we're in this for the long run. On the back of that vision and that focus, we decided to put all our energy into emerging markets. Our belief is that the developed markets focus a lot on the speculative side of the crypto economy, and we believe that emerging markets are actually showing the rest of the world about the true use cases of blockchain. We believe there's a lot of talent in these areas, and these markets are really underserved, and there is no protocol dominance from a layer 2, layer 1 perspective, and we're really venturing into that space. We started out in Africa. We have over 40 applications in the African continent now, and now looking into Southeast Asia and Latin America, hence our presence here today. So we know that we can't be everywhere all at once, so we work with partners across the globe. We work with accelerators in Africa and South Africa and Kenya. We work with different partners in Indonesia and Vietnam. And now we're working with Crecimento, which we're very excited to work with, as you guys have access to the ecosystem and our partners understand where we should be spending our time and who we should be spending our time with. So just a quick rundown of Lisk in numbers before we get into more the crux of the keynote. And I can give you a very short background of myself as well. We've been around in the space for a long time. I mentioned how we've looked after our treasury. I recently joined the Lisk team. Before that, I was a Web2 founder that turned VC. I've started 3 different funds. I've worked for firms and run different firms and accelerators in Africa, in Switzerland, and in Dubai. And I've known the Lisk team for a really long time, and I've joined because I believe in what they're trying to do. And I also, like the rest of the Lisk team, we agree that blockchains are really becoming commoditized now. So we have more of an ethos now of becoming an incubator chain and really adding value to all the applications in our ecosystem, helping them capitalize on themselves and helping the projects and startups and founders raise capital and get to that point where they can have trusted introductions to VCs and be able to onboard cash. So a big part of that treasury that you see there now is going to be shifted into investing into these areas that I spoke about and becoming an investor and not going down the typical grant route, but rather having skin in the game and developing a portfolio of companies that we can add value to. A lot of this new strategic moves you'll see in the media in the next 2 to 3 months. So I mentioned that I've been on the VC side for quite some time. I started a business back in South Africa, where I'm from, many years ago in my early 20s. I thought I was going to take over the world. I didn't. I thought the first VC that I would pitch to, that would be, I thought that I would raise tons of money. I was benchmarking, what they do in the US, but it took a long time. I had to sell my car. I bootstrapped for a long time. I eventually did raise money, and then I sold my company to a listed business in South Africa. The first VC that I pitched to, I said to myself, I want to be on that side of the curtain. So I've spent a lot of time over the last 5 years investing into projects in 22 different countries, all within the Web3 space. And I want to share some of what I think is important to understand from a venture capital perspective, what VCs look for. I think the important thing to understand, and of course there's exceptions to this rule. We have my friend Gonzalo sitting over there investing in fantastic projects that I met on Monday. He's utilizing his own capital. So there's different types of investors, of course, but stereotypically the venture capitalist, they're a product, right? They're a financial product. There's so much romance around VCs. You sit down and you pitch to a VC, you pour out your soul, like you're telling them about a company that you're developing to change the world. The reality is that straight after that meeting, they're jumping on a call with another startup that's probably in another industry. So you really need to capture their attention quickly, and you need to understand what they look for. As I mentioned, these are financial products. They have investors. They've pooled funds together. They're looking for liquidity events within a certain time frame. And in summary, they're giving you capital that you need to grow really, really, really quickly for them, because 65% of all seed investments fail completely. And VCs do not recoup that money back. So they're looking at making many multiples on their investments. If they give you 100K, they want to know, can you make me $1 million in a relatively short time frame? And that's the emotional touch points that they want to come through. So in summary, what VCs look for, and I'll get a little bit more into it in the next slide, is really when they're on a call with you or they're meeting you in person, everything for them is about risk mitigation. They're already in a very, very risky asset class, being an early stage investor. So anything that comes across in the conversation or on your pitch deck needs to give those emotional touch points that feels like the risk is being mitigated through various things. The second one is growth validation. You need to show them that you're going to grow. No one wants to invest in a business that shows a financial projection of a flat line. People joke sometimes about the hockey stick that all startup founders put on their spreadsheets, but VCs want to see that. They want to see that you believe in what you're doing and there's aggressive growth. Of course, they want to know that you have logical, calculated assumptions behind that, but a big part of it is how can you articulate points that validates growth. So in summary, if you can do a 10 out of 10 in one of these points, you'll get investment. That's my belief. So sometimes you may have a 5 out of 10 in one of these, a 2 out of 10, a 7 out of 10, and they sort of complement each other. But I can give you an example, right? So if you're a founder and you're Elon Musk, I think from some translation I got from my colleague today, I believe it was spoken about a little bit in the previous panels, but everything is about people, of course. Like in early stage investing, people are more important than anything. You're investing in a founder that needs to hire a great team, they need to lead a great team, they need to execute, pivot, persevere. Everything is really about the person that you're investing in. The earlier stage of investment, the more important people are. So in my example of Elon Musk, if Elon Musk's pitched to you and he doesn't even know what his idea is yet, he doesn't have a pitch deck, he doesn't have a website, he doesn't have a team, you'll give him the money anyway because you know his track record. We have founders in our ecosystem that have just left university, but they have touch points on some of the other aspects. So a big part of it is the experience of the founders. If you don't have that, look at ways of complementing it. So if you're fresh out of university, look at building an advisory team that can complement the skill sets that you may lack or build credibility around your project. And also act as not just, you don't want to have members on your advisory board that are just there to add credibility. You also want to have advisors that can actually help you with distribution and growth and make sure that you're incentivizing them correctly as well. The second part of it, which I guess is the most obvious one, is traction in the form of users or revenue or different metrics. Of course, that provides validation and proof that you're able to scale the business and this product market fit. And then the other one is technology. We've invested in some projects over the years that don't have any of these things, but they have such a unique technology that's been built that is so hard to replicate. That it's worth us taking a deeper look and investing into the project. The other one is partnerships. So you can think about this like distribution. If you're a Web3 product, a lot of these projects that have really strong utility battle to get adoption. So if you have, for example, Google as a partner that allows you to tap into their users and tap into essentially a distribution channel, that's going to allow you to scale a lot quicker. So understanding like what partnerships do you have, whether they're in the legacy world or they add credibility to you as an organization or the distribution channels. And of course, I guess one of the most popular metrics, I guess, in crypto is social proof and community. Is there an active community that's interested in what you're building? Is there a growing user base? I think social proof is another big point. And then finally, also, something that provides that validation is any influence that you have in the ecosystem of your company, whether it's KOLs, and I say KOLs lightly because the traditional KOL that we understand today is really just a token shiller, but there's other forms of influencers that can really provide valuable input and distribution channel and help you market your business. Any investors that you have, friends, family, anyone that you can leverage off of that shows that there's interest of people to part ways with their money and invest into a project. VCs, angel investors, friends, family, and of course accelerators, anyone that you've gotten a grant from. I think these are some of the key aspects that VCs look for. So as I say, if you have one of these, that's a 10 out of 10, it's very likely that you'll get access to funding. And then the last one, which I think a lot of people oversee. I spoke earlier about how there was 3,000 tokens in the market back in 2017. I'm sure some of you might remember how people were pitching back then. They would jump on a Zoom call with you for 15 minutes. They'll say, we're raising 500K, we've got 100K left, we're closing at the end of next week. Are you in? I mean, those times are gone now, right? Being able to close deals really, really quickly on a virtual call is gone, I believe. The hype in the space has really dissipated, and people are starving for utility. And at the end of the day, we're all humans. Whether you're in a sales job or you're a startup founder, the most important thing, and this is something that I've always said to myself for many years, is H2H. A lot of the companies may have a B2C model or a B2B model. I think something to really remember is that any interaction that you have is with a human. And I was chatting to Gonzalo yesterday, and I heard them mentioning it on the panel earlier. People invest in people, and if you trust them to do what they're going to say, then you're more likely to get an investment from them. A lot of the capital that I've raised in the past, whether raising from LPs into a fund or startup raising from VCs, if I approach someone cold through an email or however it is, it's very, very difficult to close, and the timeline is much, much longer because you have to build that rapport and trust. So always try and leverage off of people in your network that have access to capital. And then remember, I can't stress this enough, it's helped me so much in my life, is just to develop relationships with people. You don't always have to sit around a boardroom, go for a walk, meet for a coffee, go for a hike, and try and build a relationship there. And it can go a long way. Awesome, guys, thank you so much. It's been an incredible experience being in Argentina for the past couple of days. I'll definitely be back for DevCon and more work that we're doing with Crecimento. So thank you, everyone. I don't know if there's time for questions at all. Question?
Hey Gideon, how's it going? My question is regarding regulation, and is it a deal breaker or no if we don't have a legal partner yet as a part of the team?
It's definitely not a deal breaker, but I think depending on the use case, obviously blockchain being a complicated space, and depending on where you're located, like in Egypt, for example, blockchain is a big no-no. I think depending on the use case, compliance can be super important. There needs to be a lot of attention that's paid towards that, knowing that if you grow the product the way that you want to, is there going to be any regulatory hurdles? But I don't think that you need to have legal counsel in the team.
Right. Well, thank you.
Cool. Thank you, everybody. All right, ciao.